Welcome to Capital Insights. Today I'd like to talk about risk management and the risk management process in the overall portfolio management process, if you will. Very important. It's something I just do not see talked about in the financial media, but integral and really a cornerstone of our own investment process itself. Reason I'm bringing this up is that we happen to be having an anniversary in the stock market, and that is, as of August, we're 65 months into the current equity bull market. And to give you some context, if we roll the clock back, let's call it to 1930, 85 years, and we define a bull market as a price movement of 20% or more, this is our 26th bull market. But important is that we are now the fourth longest of those 26 bull markets. On average, a bull market's lasted about 31 months. Our current is 65. On average, a bull market has doubled in price. We're pushing close to a triple. Again, I'll be the first one to say, and we'll say this right now, this is not a call on the market. I'm not trying to say that the markets are topping here. The good news is absolutely no one knows when a market's either going to top or going to bottom. But the most important thing is having a risk management game plan for what you will do and what actions you will take under any market circumstances. That's really what's important. So let's talk about the components of risk management and then come back and little summation comments on both where we are now and what may be appropriate in terms of applying risk management ahead. Number one, risk management has a lot to do, and investing has a lot to do, with human decision making. What is the stock market except a crowd or a herd? That's exactly what it is. So knowing how crowds function, knowing what kind of decisions are made in crowds is very important. And you'll remember this. It's almost axiomatic. But if we run the clock back to the dot-com era of 1999 and 00, if we run the clock back 5-6 years to the height of the real estate markets, we know that when prices double, people want things twice as bad. When they go in half, people want nothing to do with them. People would camp out for 4 days to put an offer on a house 7 years ago. Well, 5 years ago, they wouldn't even show up on the courthouse steps to buy them cheaply. So as human beings, fear and greed are wired into us, but they're an investor's worst enemy. If we can, if you will, extricate ourselves from that macro, from that big group decision making, and really bring it down to the individual, and this is what's important in risk management. Defining our own goals and needs. Investing isn't about impressing other people at cocktail parties. Investing isn't about picking the greatest hotshot stock relative to your friends or your investment club. What it's really all about is making sure that you and your family meet a series of needs over time, whether that be income in retirement years, whether that be a certain dollar amount you feel comfortable getting to before you retire, whether it's children's educations that need to be funded. It's about accomplishing goals. That's it. Investors have no one to impress except themselves. And that's what's really important, because when we look at ourselves, when we look at our own needs, when we look at our own objectives, we start to frame borders around how much risk we can take with various pools of our assets. We know if certain numbers fall too low, our lives may change. That helps set risk management points. And it's setting those points and respecting those points that's really important for the individual. That's human behavior. That's one subset of how we try to frame and how we try to develop a risk management plan for every individual. Also very important is to have a sense of market history, have a sense of valuation metrics, have a sense of what's happened across time with numbers, real numbers. When we talk about things like market valuations, here's a chart. We're looking at what's called Warren Buffett's favorite stock market indicator right now, and it's market cap relative to GDP. The market capitalization of any stock is nothing but its shares times its price. Do this collectively and put it over GDP, and it gives you a sense for the value of the stock market relative to the value of the economy. There's only been one other time it's been higher. You may not want to hear this, but it's been in the year 2000. Does that mean that the world's about to come to an end? Well, of course it doesn't. It just means that risk levels, valuation metrics, are higher today than they've been in the past, and they're approaching some of the old historical highs. So what that tells us is we need to heighten our own risk management overlays in portfolios right now. One last, if you will, toolbox or tool in the toolbox of risk management is to look at what's happening with charts also, stock charts. Stock charts, charts of the market, market indices, are, if you will, nothing but a graphic analysis of human decision-making, of crowd decision-making, of herd decision-making. So it's very important to look at. One that I've used for years, and again, it's just one in a big toolbox. It's the 15 and 40-week exponential moving average of the S&P 500. But it gives us a sense for short-term versus longer-term trends and how they interplay with each other. And had someone used this valuation metric over the last 15 years, what it would have helped you do is participate in up moves, but avoid the big drawdowns. That's what's most important, is avoiding those drawdowns. Believe me, investment management, yes, making money is very important, but consistently not losing it is also very important in that totality over time and in making sure that we're attaining goals and objectives. So where are we now? We're in a highly valued market. We know that. Are we maybe in a late stage bull market? We may be. Only time will tell. But most important is to have a game plan for what we will do under any market circumstances and how we will manage risk. Protecting profits, very, very important. That can involve putting hard stops under certain individual securities, below which we will just not allow them to fall, period. That also means respecting asset classes, where their valuation metrics may lie on the historical perspective, and again, drawing lines in the sand under which we will either reevaluate and or leave the asset class itself. Those are important, if you will, objectives in markets like this, and these are important tools to implement in order to, if you will, protect profits over time. For those who have very, very serious tax consequences, there's hedging strategies that we can use, insurance strategies. They come with a cost. They're not free by any means, but it's making sure that, again, we're in tune with the individual goals, objectives, and needs of various clients, and that we apply the right risk management overlays to their portfolios, depending on where we are in these historical cycles, where we are in this rhythm of the markets. And that's the key. Markets are a rhythm. They're never straight up, they're never straight down, they revert to the mean over time. It's never different this time. And that's what we need to realize when, again, we both talk about, explore, define, and implement risk management strategies. We've been in this business a long time. It's been said that some of the most dangerous words in the market are "it's different this time." But I would submit to you that some other very dangerous words are, "what do I do now?" We don't ever want to ask ourselves that question. We always want a game plan for what specific actions we will take under any market outcomes. The best plan for offense in investing is a really good plan for defense. On behalf of the entire Capital Planning Advisors team, we very much appreciate your time. Thanks so much for being with us. We'll see you soon. I'm Pretti.